Please welcome.
This is another episode of the Defenders of Business Value podcast, a podcast where we talk about what makes a business valuable, learn the tips and tactics to increase your company's value that only veteran deal makers know. And now, here's your host, Ed Meisselgland.
Good morning. This is Ed Meisselgland, Managing Partner of Indiana Business Advisors. This is our second office hours that we open up our shop, that we're for questions that concern buying a business, selling a business, the value of a business, and the general process, especially in this current economic climate. Today, I'm joined with Jamar Cobb-Dennard as well as Larry Metzing. So, welcome, Jamar. Would you mind giving a little high-level overview of yourself and the things you're doing in the practice?
Sure thing. So I started in consulting and in leadership and sales consulting in 2003, and spent that time really serving small businesses, helping some of them increase sales over 40%. Then got my law degree and graduated in 2018. Ran for mayor of the city of Lawrence and earned 49% of the vote. Now helping buyers and sellers close transactions of their business to not only pull cash out of their companies, but also growth or acquisition.
Well, we're glad you're here. How about you, Larry?
Larry Metzing. I've been with Indiana Business Advisors now for close to 40 years. Founded it in that period of time with Dick Hester, my partner. We've been doing small and medium sized business transactions now during that period of time and have done a couple thousand plus. So we've got a lot of background and experience. In addition to doing a lot of business deals for Indiana Business Advisors, I've done a few for myself. So I have stepped into the shoes of both buyers and sellers on multiple occasions. So it gives me a little better feel for how the process goes and what you all feel on the other side of the equation. So I think what we would like to do is just answer questions today that you all may have regarding, what's going on during this pandemic and how our business is reacting to all of this. Are there buyers? Are there sellers? And has the process changed as a result of all of this? So hopefully we'll be able to answer some of your questions today. Yeah,
and speaking of questions, if you have questions in the chat box, go ahead and put those in. We're monitoring that. Our marketing director, Chelsea, is also on the back side of this, keeping an eye on it. We did receive a number of questions prior to the webinar that we'll begin with. But like I said, if you have questions as we go through, please put them in the chat box. So with that, why don't we go ahead and get started? The first question we received are, what are the financing options to purchase a business today? Larry, I think you're knee deep in the middle of that.
I would say we are knee deep in the middle of that. I don't think the options have changed dramatically yet. The options that were historically available to us, obviously, you always have conventional bank financing. You've got SBA financing, which has probably been the most prevalent financing tool that we've used in the last, I'd say, 10 to 15 years. A majority of the transactions under $5 million that we do are typically financed with SBA financing, and there are some other, I would say, more creative financing, whether that's seller financing or some sort of earn-out, performance-based payout. But I think the options have changed. I feel like the SBA money is still there today and readily available, although everything that we read with the PPP program and the CARES program and the amount of money that they've allocated the SBA, it feels like there is concern that some of the SBA financing might not be available or as readily available as it has been before, but only time will tell on that one. There's talk about the fact that they may run out of 7A money, and 7A is the program that we typically use for acquisition financing. And They're talking about the fact that they may run out of allocation on that. They're working to get more allocated, which we hope will happen. And at the end of the day, they may change some of the criteria, some of the SBA underwriting criteria to require a little more equity than they do today. They may also open up the opportunity for some performance-based payouts in the form of earnouts that they haven't had before. So I still think those tools will be available. I sense that some of the underwriting has tightened up a little bit. I heard, I don't know whether there's any fact to the rumor, that one of the major banks has basically pulled back all of their SBA financing, anything that they have in the queue today. And even if it's gone through underwriting and been approved, they're pulling it back to take another look at it under the current economic circumstances to make sure that it still makes sense, that the numbers still work. So I think you're going to see a lot of moving parts as it relates to SBA financing over the next 60 to 90 days. The really good news is if you do get SBA financing between now and I think it's September 27th, that if you close the deal between now and then, it's my understanding that under the CARES program, there will be 6 months of forgiven payments. So your first 6 months of payments are forgiven, and that is about as unprecedented as the times that we are in. We've never seen a situation where the government picks up your first 6 months payments. So that's a huge benefit. And then if you combine that with the PPP program, there's some real benefits to buyers today with SBA financing on an acquisition. But I still think even if we evolve and we don't have as much SBA financing available, we'll end up doing more seller financing, just like we did before the SBA was so prevalent.
Yeah, what does your crystal ball look like? I mean, I remember when we went through the recession last time, I mean, we still had conventional financing. You know, it was not it may not have been the capital was completely as available as it is today, but it was still available. So, I mean, what does your crystal ball say? What do we look like a year from now on business financing?
I wish I had that crystal ball. I don't. I think a year from now, I don't know. So much of it depends on what happens. And I think in the next 3 to 6 months, second quarter, third quarter, if things can recover and we can get back to financing normal, meaning we've gotten some of the pandemic under control, I think you'll see SBA financing as prevalent as it has been in the past. Yeah. It's a great tool, and there are just too many businesses in America that are going to change hands over the next 10 years. You've got to have some financing to facilitate that. So I don't know. I don't think it'll look significantly different.
Hey, Larry, I've heard a lot of feedback from small business owners that the PPP pipeline has slowed down their SBA applications, or their bankers are so busy dealing with all this other bailout stuff that they're not able to get new deals done. What have you seen in the marketplace about people being able to actually get transactions done based on pipeline?
I think it's really tough. You're right. Every banker is absolutely swamped right now with the PPP applications, the CARES applications, but especially the PPP program. So they're buried. A lot of them are not looking. Some of them are not looking at new loans. I've got 2 right now that are looking at new loans. But the big issue is just getting them to allocate some time to that. Well, yeah, it's definitely slowed down. Yeah, I would agree 100%.
And on top of that, and we follow the International Business Brokers Association, and there's currently a petition going around that, so much of the budget has been allocated to the PPP and the disaster loan component, which again, I'm not saying that it doesn't have merit, but the budget for 7A and 504 loans is going to be eaten up by June 30. So I think it's Marco Rubio from Florida is chairing that committee to, again, go back to the well and get additional funds for this, the greatest wealth transfer in history. So, yeah, it's going to be a real interesting run here certainly for the next 6 months, maybe to year end, to see how this whole thing plays out. I'm optimistic. I mean, I think to see what the federal government has done just to keep companies afloat. I mean, those are, there'll be casualties, but nevertheless, it could be a lot worse. All right. The next question that came in, is what should I expect from valuations as a seller with the upcoming economic slowdown? Either one of you two.
Ed, what do you think?
Oh,
you're the valuations guy.
Yeah, I mean,
what's your crystal ball look like?
Yeah, quid pro quo. Yeah, the tough part with valuations is that there's no empirical data to surround yourself on guidance. I mean, we've got 7 or 8 valuations that are backed up here that we're trying to provide sound guidance on what to do and how a buyer will react. Now, we know that just by virtue of this pandemic that it has stress tested a number of businesses. So the ones that have prevailed and have come out of it, do they warrant a premium? I'm not certain that they do. Maybe, but I'm not certain that that's the case. Now, as we look at business valuation, it's based in 3 buckets. You have earnings, you have risk, and you have expectations. So earnings, we know, are going to perhaps have changed. We know we'll have to adjust for non-recurring expenses associated with the pandemic. Maybe lost revenue, lost earnings, or perhaps income that's been received from the federal government. Things like that we have to make adjustments for. As far as risk goes, it depends on the business. The risk associated with businesses in general, especially at this level, they're amplified. That small, size matters in risk, and in small business, it's inherently risky. So, how much more risk do we apply post pandemic? And that, it's not like we're getting lots of transaction data. If we have time at the tail end of this, I'll share some of the guidance that we've received from the associations and kind of where everybody is seeing deals going. So I'll do that at the end. And then as far as expectations, good luck. I mean, that's the $1 million question, but it always has been in small business. Forecasting a $1 million company, what does the next 6 months look like is probably easy. What does the next 3 years look like? Probably not so easy. And so we're still in the same camp. But I don't think valuations are necessarily going to change. I do believe that the structure, in order to accommodate the risk of the sale, will change. And I was telling Larry the other day that, I'm authoring with some other folks, some recommendations for the Small Business Council, that Marcus Rubio, is part of that, right now, earnouts exclude, disqualify a deal with the SBA. That's a wonderful vehicle to mitigate buyer's risk, and that needs to get put back in. Same thing with owners transition. They can only stay right now. They can only stay a year. Well, if they could stay 2 years, would it mitigate the buyer's risk and help them, get in there? So I think those are a couple components that I don't think valuations are going to change dramatically. I do think that structure will change. So either of you two have any additional comments? Jamar?
Yeah, I do have one follow-up here, and that's, it sounds like valuations are done in a way in a vacuum, especially using historical data. And how does that compare with most probable selling price and the actual market value that the buyer sees within that business? Because there are some buyers that may want to purchase a business at a discount because they see lower value in an industry or where it trends, or others are looking to pick up a new business strategically so they can add customers versus spending money on new customer acquisition via salespeople or advertisements or et cetera. So how do you really think and compare? How should we think about the historical and market data used for valuations traditionally, and how buyers could see these deals right now?
Yeah, Larry and I have our dog and pony show has been surrounding that for most of my career, and value and price are two different things. I'm the value that I share. This is the way a buyer should behave toward this investment, given all the other alternative investments that they have. When it leaves my hands and it moves into your hands or Larry's hands, it's now you need to get that buyer to behave irrationally just by virtue of the process. You have people that are, competing for the opportunity. So when they compete for that opportunity, you need to facilitate a deal that's greater than fair market value. At least that's what I'm counting on. And normally what we do see is, either our valuation is pretty spot on, or it's undervalued, and it's undervalued from the standpoint of the price versus what the value, what I came up with. And so, it's a different animal, but like you're saying, it is the empirical evidence, it is what it is, but the process facilitates a premium, or, and again, you got to remember that the number of businesses that don't sell is substantial. So you have that component to consider also, that, and it's not like real estate where you have thousands and thousands and thousands of market comps, and you can drill so far in. I mean, if we have 20 or 30 that we can apply to the particular business, I mean, we're in pretty good shape. So anyway, Larry, I saw you locked and loaded. Go ahead.
No, I'm not locked and loaded. I don't think that. I know Ed talks about buyers acting irrationally, and that's not irrational compared to his statistics or his empirical data maybe. But at the end of the day, the one thing that we've learned after 40 years in this business is that if a deal goes together, that means buyer and seller are both happy. I can tell you if a deal does not go together, if the buyer thinks he's paying more than he should be paying, or the seller thinks he's getting less than he should be getting. At the end of the day, they both have to be happy. So I think what really happens is the process will provide competitive bids, hopefully. And at the end of the day, the market speaks. The market is the market, and it may be equal to what Ed comes up with value. It may be more. It may actually be less than what Ed comes up with. And in this situation, I think the market is going to be very interesting. You can take it to the bank that every buyer that looks at a business, if that business was impaired negatively as a result of the pandemic, the buyer is going to beat you up on valuation. That's just the way life is. That's been that way forever. If you have a down year, if you have 2 up years and 1 down year, they're going to beat you up based on the down year. But at the end of the day, if you get buyers looking at the business, you're going to end up getting a fair market value. So I think as we position the company, I think you've got to look at what happened to that business during this period of time. And can we foresee that happening again? And if it does happen again, then yeah, there is going to be an impairment to the valuation. If this was a blip on the radar screen and we're 6 months past this and we're back just, I mean, I actually talked to a friend of mine that owned, I mean, you think food and beverage is getting really beat up today. Well, he owned a group of fast food, a popular fast food chain. And while the numbers during the initial stages of this were down, some of the numbers today are equal to or better than they were for the same period last year. So a lot of businesses really are doing as well. They may have had that little blip, and you're not going to beat some guy up on his price because he had a 1 month blip. Everybody had a 1 month blip. But I think the process is still going to be very similar to what it's been in the past, but I think you're going to have to look very closely at those adjustments that we might do to EBITDA. Today, we add back a lot of things, we deduct certain things, and I think you're going to have to focus on the financial impact of this short period of time. And there may be some add backs as a result of that.
Yeah.
It's just a matter of whether the bank will accept those add backs. But if they're thought out from a rational standpoint and presented logically, they'll probably accept some of it.
Yeah, I know a number of deal guys are presenting the business in trailing 12s. So, you know, you're and I don't know, I haven't seen enough of it to know whether or not it dramatically changes the position of the company, but it is an interesting way to I suppose put the business in a different light, you know?
Well, we think about the negative impact of the pandemic on the financials. What about the positive impact? Sure. What about some of these companies that their revenue is up 500% period over period?
Yep.
You know, I'm not going to, if I'm doing the valuation, if I'm buying that business, I am not going to make the assumption that it's going to move forward at a 500% increase every month hereafter. So I think you've got to adjust it accordingly. There's no way anyone's going to pay a premium based on 3 months of record earnings based on something really, really unusual, or at least they shouldn't.
Yeah, I get it.
Now, if you're selling the disinfectant hand wipes, those are probably going to be around for a while, and they're probably going to have significantly better sales than they've had in the past for a period of time. It's kind of like toilet paper. You can only use so much.
All right. Our next question. So what are the threats to businesses you see amid the current pandemic? Jamar, why don't you take that one?
Sure. So one of the first things that I see as a threat to business during the current pandemic, first is not being able to shift within what's happening in the marketplace. So the tough thing right now is that things are changing on a daily basis, and there's also a lot of uncertainty coming from our national and our state leaders. And really that's not just from a policy perspective, but also how their decisions on their policy are being communicated. For example, the Indiana governor has a 5-phase reopening plan. And as I not only watched the press conference and then the comments from the press conference and then the articles from the press conference and, that kind of trail of information afterwards, people were just confused. So being able to handle the new information coming in and making decisions off of something that seems uncertain is tough for leaders and tough for the business environment. But also shifting and thinking through, what do we do now? What type of strategic decisions do we make based on how things have changed? For example, Larry talked about different business sectors that may be way up or way down. And there are some companies that are shifting their operations based on other sectors that are up right now, and really thinking of where they can actually still sell, or how businesses are actually triaging. So I was reading an article in Indianapolis Monthly yesterday about how a restaurateur with a group of restaurants, including the Rooster and Black Market and three others, how he had to make decisions in Siam Square down in Fountain Square, how he had to make decisions about closing 4 of his restaurants, but leaving Siam Square open for takeout because they already had infrastructure for takeout. They already had people ready to shift. The marketplace already knew them for takeout, but also had to make the tough decisions about shutting down temporarily those other 4 restaurants. So, even though we're a couple months into this and the pace of change is starting to slow, and we're also starting to understand what the at least short-term impacts of this are, a lot of business owners have yet to turn the corner in making the strategic shift and thinking critically about how their businesses are impacted. One of the other things that we need to think about in terms of the market is how supply chain shifts. So it's really weird that there are some farmers that are throwing away millions of gallons of milk because there is a lack of demand because of food service and schools and restaurants purchasing. But then on the flip side, because of coronavirus and COVID-19 hitting meat packing plants for beef and chicken, there is an undersupply, and I guess Wendy's is preventing people from buying hamburgers, right? So those are 2 examples in food, but supply chain with the number of workers, how fast products can get to people, the number of folks who are actually working in some of the factories and distribution centers, that's going to be impacted as well. And then finally, just a general squishiness in the marketplace has been a result not only from uncertainty, but also people just being gun shy. But with that uncertainty, there are a lot of business owners who will thrive during the midst of uncertainty and will thrive during an economic downturn because of what they've done with their mentality and how they're shifting in the marketplace. So those are my thoughts, Ed.
Thank you. Larry, you got anything?
No, I'm good.
Let's see. The next question, when do you foresee M&A activities will pick back up? Back to the crystal ball. Anybody?
I would say there's a slight slowdown today in the number of businesses coming on the market to sell. I think everyone's kind of in a holding pattern. They may have been thinking about it before all of this. Their numbers, their financials may be impacted negatively. And I think there's a little a hold, a pause on maybe thinking about, I think they'll continue to think about selling the business, but they're going to question whether this is the right time to put it on the market. So I've seen a little slowdown in the number of sellers that are coming into the market. So I hope as we get into the fall, some of those people will start reconsidering it. And once again, I think they'll reconsider it based on what's going on at that period of time with their business and with the economy. So I would think, I feel like it should start picking back up third and fourth quarter for sure.
Okay. Like I said, I have some.
So I do have one.
Please.
Sure. So I do have one kind of follow-up thought for Larry, and really to get your feedback on this as well, to fill in the blanks. But I guess for those business owners who are gun shy about putting their business on the market, why is now a good time to begin that process? As I've been having conversations with some of our clients, we've been talking about one, the length of time it actually takes to get your business on the market between developing the marketing materials and physically cleaning up their business and getting their financials together, and et cetera. Second, with the length of time it takes to sell a business, 6, 8, 12 months of being on the marketplace, of being prepared for the market and on the market when things start to turn around, the availability of additional financing vehicles like you talked about before. So, I mean, what are some of the other things we should think about in terms of why now is a good time to get back and put our businesses on the market?
Well, that's a good add-on to my comment, because based on what I just said, I really think now would be a good, if you're thinking about selling, I don't think there's a downside to putting it on the market today. And the upside is that there's not as much noise in the market. There is not as much competition when buyers are looking at businesses to buy, and there's still many buyers. We're still getting a lot of calls from buyers. And I think a lot of these buyers are folks that, they're looking at the current situation like most entrepreneurs have historically. I don't really want to work for the other guy, especially if there's a chance that my employment could go away at the flick of a pen or a flick of a virus or whatever. So I think the buyers are still out there, but there aren't as many sellers. I think today's a good time if you're thinking about selling. At the end of the day, you're going to sell for the price you're going to sell for. And if you don't want to sell if the market tells you that your business is worth 20% less than you thought it was, you don't have to sell. But right now, I think there's not as much competition. When a buyer comes in here, there is less inventory for that buyer to look at than there was a year ago at this time. And I just look at the deals we've got in the pipeline right now. We've got probably a dozen businesses that we have offers signed both ways, and they're all going to close in the next 30 to 90 days. That's another dozen businesses that are no longer available for anyone to look at. So I think if I were a seller, it's not a bad time at all to be thinking about put your business on the market and let's see what the market looks like.
Yeah, and as we were just doing our month-end stats, and I mean the number of buyers that are entering into our world or into our sphere looking for deals is increasing. And I think what you find at the conclusion of any kind of economic, storm like we have, whether it be a recession or a war or a pandemic, I think you find that people get displaced and they're not going to let that happen to themselves again. And they start looking at how to get into business for themselves. And so we've seen an increase in our buyer throughput. And so, and that's why we're doubling down so hard on our sell side work, is because, it's a really good time to be thinking about them. And I don't mean it from a commercial standpoint. I truly mean it from a business owner standpoint, that as far as positioning your company, now is a really good time, because it's going to take time to sell it. And I do think that there's going to be available financing. I do not believe that the federal government is going to let the $13 trillion wealth transfer just evaporate. So having said that, I mean, I think that we're going to see an influx. Now, I think you're also going to see a slew of businesses that, are on their last legs, and, somebody take this, I don't want any cheese, I just want out of the trap kind of thing. And that's going to be, I think we're going to see a lot of that too. But at the same time, those are going to probably be some really good opportunities for somebody. And
absolutely,
whether it's growing through acquisition or what, I don't know. But I do think that from an inventory standpoint, we will certainly jump.
And there are some of those businesses that are going to be in trouble, that are in trouble, and they may not necessarily be in trouble as a result of this pandemic. They went into the pandemic. They may not have been managed well going into it. So they obviously were not managed well coming out of it, and they couldn't come out of it. So you're going to get management situations. You're going to get undercapitalized situation. If you go into a situation like this and you're undercapitalized, that's the anchor that's going to drag you down. But if you, as a buyer, have the magic sauce, You can bring better management to it. You can bring more capital to it. You may be able to bring, once again, the magic sauce that the previous owner didn't have, and you're going to get a real bargain buying that business.
Yeah. A question that came in through the chat. What typically are the underwriting ratios you think will tighten? I don't know about you. I'm not certain that debt coverage ratio of 1.3 is going to change much.
It's been that for 100 years, so it's probably not going to change dramatically. I think there's a chance that from an underwriting standpoint, the SBA may tighten up on the amount of equity that they might require, which could be, partially cash equity from the buyer and standby seller financing. So they may tighten a little bit on that. And some of the banks may tighten up a little bit. Just once again, based on the current economy and the unknown about the next 6 months to a year. So I think, but I don't see like the debt to equity might change a little bit, but the debt coverage ratio of, how much free cash flow you've got to have to service that debt, I don't think that'll change dramatically.
Yeah, I don't think so either. The interesting thing is like you were saying with the bank, that the bank is requiring, the additional scrutiny to mitigate their risk, which I think is the more prevalent speed bump than debt, trying to make it fit in the box. I think, they're trying to perfect their loan, and I get it. But again, most of the risk is with the buyer, not necessarily with that lender. The lender, especially SBA. So and for those of you who don't know, the mechanics of the SBA loan is that you have a primary lender, which is the banks that we all know, and they have the federal government guarantees a portion of that loan, and typically 75-80%, right?
Right.
And so our local bank is only has exposure of 20 to 25%, and that's what we're talking about is does that when you look at risk and they're requiring additional scrutiny for their 20% versus the personal guarantee from the buyer, as well as the SBA that's guaranteeing 75%. So,
well, I think at the end of the day, too, the underwriting, they're certainly not going to loosen it up dramatically, because the bigger issue for the bank is their historical performance with SBA loans. So they have a preferred, a certified lender status, which allows them to basically underwrite, commit, fund, document the loan internally, which makes it go a lot quicker and a lot easier. They do, and most important, they get a ton of fees. The bank makes a ton of fees as a result of doing SBA loans. They do not want to lose that. So they're not going to loosen their underwriting criteria and take the chance of running into loan losses on SBA loans in the future, because they'll lose that certified status. So I think they're going to continue to underwrite fairly tight. The other thing that I've just seen recently, and this is first time ever, we have a transaction that is pretty far along, and the bank has requested, they always, if there's real estate involved, they always want a real estate appraisal. They want a business valuation done almost any time the loan's over $250,000. If there's real estate, you've got all the normal real estate, environmental appraisal, et cetera. And in this case, they are requesting a quality of earnings report from an independent third-party accountant.
What is that? What is a quality of earnings report?
Well, that's the first time I've ever seen a Q of E report requested by the bank. So basically, the best way I can describe it, it's a mini audit. It's a mini audit that's done by the CPA firm, where they basically dig in and if the business has $5 million in revenue, we want to satisfy ourselves that $5 million in revenue is real, that it came from the operations of the business, not selling used cars out the back door. et cetera, et cetera. So we're looking at, if you got 6 million, it's an audit. They're going to look at, you got 6 million in revenue. They're going to look at the bank statements during that year, and they're going to make sure that, that 6 million in revenue that's on the books actually got deposited into the bank. And they're going to do some ticking and tying and tracing some of that, just to, once again, satisfy themselves that the earnings that have been reported are fairly accurate. Not 100% accurate, just fairly accurate. Now, you can have a limited scope quality of earnings, which we might just focus strictly on revenue. You might have another limited scope that would focus on cost of goods sold only. Is it accurate? Is it accounted for in the proper method? So, once again, just think of it as a mini audit. And they can change the scope. And my question to the bank was, under what circumstances, is this an SBA policy or a bank policy? And in this situation, it's a bank policy. They started it back in the fall. And so my question was, under what circumstances do you request or require a Q of E report? And they basically said that if the loan's over $2 million and or the buyer has a limited or no experience in the industry. And actually, at the end of the day, performing a Q of E is probably a really good idea under those two circumstances. Mm. Now, I haven't seen it with any other bank, only one bank so far, but it could catch on. And I'm sure if the accountants have anything to say about it, they'll lobby hard for that.
Yeah. Jamar, I wanted to ask you, I've seen that you've been a panelist on a number of different areas, or in a number of different areas. What are you hearing and feeling from the small business owners that you're serving and that you're speaking in front of?
Sure. And I talked about this a little bit earlier.
Yeah.
One of the pieces is the uncertainty. But what we've been countering with is how to think about this downturn. So I did a little bit of research, and since the Great Depression, any average economic downturn has lasted 9 months. The longest was 2 years. Since the Spanish flu of 1918, any flu-specific pandemic, the longest that's lasted is 2 years, but there are also shorter flu pandemics that were about 6 months. So for all the doom and gloom business owners out there that are thinking that the sky is falling, it's not. And over the last century, it hasn't. Now, there have certainly been some tough times, yes, but the reality is that this thing is going to end. And as entrepreneurs, as business leaders, and as those who are maybe involved in transactions, getting out or into or adding on to businesses, we've got to be prepared and ready, not just for the end of this thing, but how to get through it. So that's number one, is just how to think about what's going on right now. The second thing is access to financing. There's a lot of pain out there right now with business owners trying to figure out how do I get through payroll over the course of the next 2 weeks, month, quarter, et cetera. How do I help my team that's really suffering? And the other half of that is that as they continue to operate, you've got to take a lot of time to research what all these resources are. So I'll share a couple. Obviously, Larry mentioned the SBA and CARES Act relief that's out there. Indy Chamber and the city of Indianapolis just released, I think it was $25 million in relief, which isn't a ton, but it's additional relief. LISC has just released $5,000 small business grants. So again, not a huge amount of money, but when we compile all these things together, they're helpful. I believe it's Kat Sapper-Miller has a COVID-19 relief page on their website with not only accounting and financial help, but also financing help to find additional sources of funds. So these things are out there and they are compiled. But, those two things in terms of general feeling is one, getting people's minds right and getting the money tight. And that's what's going on in the marketplace.
Yeah, and for the small business owners that are currently on the line, if you go to the state's COVID resources area, I mean, we just they have where they'll give you masks, shields, sanitizer, and a couple other things. Based on the size of your company. So 0 to 50 employees gets this package, 50 to 100 gets this package, and it's free. So if you just go to in.gov, and I believe it's COVID, that'll get that. That's a free resource from the state. All right. So next question: if valuation expectations are not changing much for sellers, how should buyers think about an earnout as a percentage of the transaction price to reduce risk? Either of you, or you want me to take it?
A percentage?
Yep. So if valuation expectations are not changing much for sellers, how should buyers think about an earnout as a percentage of the transaction price to reduce risk?
Well, I would just have to say that's much more of an individual transaction consideration. I think you've got to look at if it were negatively impacted during this, what's the risk of not returning? Is this a situation that's going to continue for a short period of time or a long period of time? Is it a 6-month recovery or a 2 or 3 year recovery to get back to normal? So I think you're just going to have to look at each individual deal, but I would certainly, I would see, that's a tough one. I think it should be, I'd like to see it be a minimal amount on the earnout, but depending on the situation, I mean, it could be a significant amount of the purchase price is tied up in a performance-based payment.
Yeah. I mean, I think the first thing for you as the buyer that's looking at this situation, are you going to need SBA financing? Based on the current regulation, if you're going to employ an earnout as your risk mitigating vehicle, it's going to disqualify you. And so if you have the capital to finance it, then that's one thing. And you could probably, lop as much as you can into the if then financing earnout vehicle. But if you're looking at, conventional financing or SBA financing, I think you're in for a long road. But and in that case, if you are looking at SBA financing, then you might be able to deploy what's called a self-canceling promissory note. It basically acts as an earnout, but is in the form of a promissory note. All right, Jamar, you got anything on that? Okay. I have, now you guys haven't seen this, but this just came out. Can you should be able to see my screen. This is from this is called the Market Pulse from the International Business Brokers Association. This just rolled out. And if you guys want to comment as I go through it, that's fine. And like I said, these guys haven't seen it either. It just literally came out. So you can see that, roughly half of the deals have been delayed, and about 10% of these deals have been canceled. All right. Let's see. Reason for cancellation. So again, buyers pulled back here. Less than 2 million, greater than 2 million. So again, it's about 50-50 that the buyer canceled. Quarter, the seller canceled. And then, which to me, this part is the most interesting thing, is that the banks were still there. But I guess when we look at the composition of the 12 deals we have, I mean, the banks are still there. We may just be on hold, but they're still hanging in.
Well, as an example, example on that one on hold, we've got one business that is non-essential, so it was closed during this period of time. the bank is still going to finance it, but they won't finance it until the business reopens, which should be next week.
Yeah.
So once they reopen, the bank will step in and finance the acquisition.
So we were talking about, how long of a delay this will be. So you can see, 1 to 30 days, very few think so. Most people think that, it's going to be a 90-day plus ride, in order to get these things closed. So it's somewhere between 50 or 45 and 90 days that, to get the deals done that are currently on. Now we're not, like I said, we're not seeing that, and we participated in this survey. Let's see, businesses that are for sale. What happened to them? 40% were at partial capacity. 4% benefited. 21% were unaffected, and 35% were temporarily closed. So for the valuation questions, 81% of people, or deal folks, expect that valuations will decline. But I don't see a huge change. I mean, like Larry was saying, we're talking 10, 20%. If you're going to lose 10 or 20% in your stock portfolio, what would possibly give you the indication that you weren't going to lose money in your small business? I don't think market sentiment. I think I have here's kind of how the seller's market goes. They're all decreasing. And again, this is quarter over quarter. Okay. This number here is from 2013 to 2020. Okay. So let's see, where are business valuations trending? So as you can see, there's a little bit of a dip in each category, with the exception of the 500 to $1 million. We were thinking, valuations were going, price, and this chart that we're looking at is the final price realized versus the asking price. This is a lot of the deals here in the 500 to $1 million range. And again, I think that's by virtue of the process that you get a higher sale price. Now the multiples.
Going back to that last chart.
Yeah.
And so basically this is saying Q1 2020, and the tail end of Q1 was obviously the beginning of the economic blip. But so this is saying that the final price that was gotten from the deal versus asking price is actually higher in almost all cases, except for
greater than 5, the
larger deals.
Right.
So we started out very strong this year.
Yeah. But I think everybody, I think, you saw our throughput. We were, and we still are. There's a lot of activity. Again, like I was saying in some of the material that I'm authoring is, this wealth transfer isn't going to stop. So that's why we need the SBA to come alongside. Even though we have a pandemic, they need to come alongside and help us out. And this is kind of the same thing, that we were coming out strong, and I don't think we may pause for a minute while we catch our breath, but I think it's going to pick right back up.
Yeah, I saw one of the comments on the sidebar of this report, and it talked about how those that were nearing retirement and wanted to sell because of retirement, that's not going to change. And they're still nearing the end of running that business. So, like you mentioned earlier, the companies that were in poor financial state, nearing retirement, owners who are ill that need to get out, buyers who may have lost their job, don't want to deal with the uncertainty and want to purchase their next job through business, or businesses that are in acquisition. Those deals are still going to happen. It's all good.
Yeah. So, market multiples, again, it's not like it's the stock market where it's a total wild ride. You can see that the multiples slipped in the lower middle market this quarter, dropping below market peaks. Historically, the multiples on Main Street have varied within about a 10% range. Cash at close. So for the fellow with the earnout question, you can see, here's some guidance on these earnouts, and seller financing. So typically, you're running, 75 to 80% cash at close plus, a component of seller financing, 10 to, or 8 to 17%. And that hasn't really changed. Let me see if there's anything else. Why are they selling? You can see the biggest reason is because of retirement. Okay. And that, again, that's not going to change. This is, who the buyers are, for those sub $500,000, most of them are first time buyers. Those that are under $1 million, again, half of them are first time buyers. 1 to 2 million, again, first time buyers. And then we start, once we get north of $2 million in transaction value, it starts moving into, strategic buyer. There's certainly some people that are acquiring, as a job, but most, as we start moving up the growth or the size chain, we start seeing, businesses that are, business acquiring business to grow through acquisition. And then 5 to 50 million tend to be private equity or strategics. So what are they buying? Now, you can see that it's, sub $500,000. It's, a quarter of the time it's restaurants, personal services, and then consumer goods, and then healthcare, and $500,000 to $1 million, healthcare to personal services. Once you get north of $1 million in transaction value, you're moving construction, engineer, personal services, manufacturing will always be there, wholesale distribution, and then north of 5, quarter of the time it's healthcare, wholesale, and business services. And I think that's that. You can, if you go to the Pepperdine Grisadio Business School, they are the ones that manage this. Let me get over here. Any other questions? I know we're coming to to the end of our time. So anybody else have any questions? All right, Larry, you got any final thoughts?
No, I think I'm good for the day. My crystal ball is about as foggy as it can be.
Excellent. Well, Jamar will come through for us. Jamar, what are you thinking?
I'm just going to say that statement you made that there's a lot of sellers who don't want to eat cheese. They just want out of the trap. I think I'm going to take that one to the bank and write it in my journal. That's a saying for posterity. Well,
the funny thing is I have to give credit where credit's due. The guy to the left of you on my screen is the one that authored that. So I don't know. And I don't know where he got it.
He authored that because he's been in that position many times.
Right. So I'll close this up by saying, we've been around for 40 years and we've had an open shop, and anybody that you talk to will attest to it, that, we're generous with what we can give you. And if we need to turn the meter on, we'll let you know. Having exploratory conversations and things like that, that's what we do. We do it every day. This recording, Chelsea will send that out to everyone that registered with us, and we will be happy to, field questions from there. It'll also be on our podcast, Defenders of Business Value. That'll be released later on today also. So our next session, I got a last minute question. What's our cadence? Our cadence, we'll show up as long as people have questions. And right now it seems as though every other week seems to be good. If you go sign up for our newsletter, Chelsea regularly pelts people with these opportunities to come visit with us. So if you want to be part of that, just sign up for the newsletter. You can reach out to Jamar or Larry or if you're working with a broker in our office, reach out to them and just make sure that they'll take care of you. So with that, on behalf of Indiana Business Advisors, we thank you for your time and we hope to serve you sometime. Thanks so much.
This was another episode of the Defenders of Business Value podcast. For more episodes packed with strategies to increase the value of your business, visit defendersofbusinessvalue.com for show notes, transcripts, and free tools to start you on your journey. Subscribe now so you don't miss any future episodes.